Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to get pre-approved and buy a house in Dallas, Texas, and you're wondering what documents are really needed for a pre-approval and why? Stick around. In this video, I'm going to teach you all the secrets. So buying a house is the biggest investment and purchase of someone's life. Most people that have not bought a house before, it's been a long time since they bought a house, forget that mortgages are extremely regulated. There are a lot of documents required. It is the opposite of most financing. You can go get furniture the same day. You can go get jewelry financed. Even something as big as a $100,000 car, while that's a big purchase and is very expensive, that industry does not require and regulate the financials as strong as home loans. And sometimes I think people think that buying a house is just maybe a bigger version of a car and it's easy. They can do it pretty quickly and it's not so invasive. And I'm going to be here to tell you it couldn't be more opposite than that. Now, mortgages are regulated for a few reasons. After the subprime crash, they want to make sure that they don't have any big surprises, fraud, people can perform, they'll make their payments, and so there is some good and heavy restriction, but the downside are the documents that are required. Now, I will tell you up front, these documents, for the most part, 80 to 90%, are not going to change from lender to lender. Mortgage companies don't have their own rules. Here's a secret. We have to follow the government and the people that are putting out the money, and we are just the facilitators. So I want to draw a clear distinction on two things, a pre-qualification and a pre-approval. Pre-qualification is you talk to a lender, maybe tell them what you have, tell them what you make, fill out an application, but there's no validation of all the financials. That is a bad sign. People a lot of times don't understand the extensiveness of what we got to go through to back up all that income and assets and all that, and it's best to do it up front. We're on a pre-approval. It might take a couple extra days to get the pre-approval done, but you really want to send your documents into the lender to let them look at everything to make sure what you tell them and what they can use are the same. I have too many horror stories. I have too many realtors. I have too many potential home buyers call me last minute and say, man, this lender screwed up and they didn't verify this and now I can't use that and what's the deal? I will just encourage everybody. Hopefully we earn the business and we do everything up front, but if we don't, a word to the wise is don't skip steps. Spend an extra 2+ days with your lender. Make sure you're getting all the financial documents together and make sure they're validating those up front. So let's talk about what is required and why it's required so you guys understand the why and put yourself in a good position. So the truth of the matter is, when it comes to an actual pre-approval, the main documents that are needed obviously is an application which you'll fill out. They're going to need your W-2s to figure out exactly what your total income was for the past 2 years, whether it's the same job or a different one. If you're a W-2 wage earner, most 30 days pay stubs, pull a credit report, and then some lenders will want to look at your assets, meaning how much money you have in the bank, 401k, all that stuff. Me personally, I don't look at it. I just ask them, I make a note of it, I make sure everything is clean, it's all payroll money, and we verify the assets later because those statements are only good for like a month. Sometimes people are on the home search for maybe 2 or 3 months. I'm gonna have to ask for them anyways, so I don't wanna have to ask for them twice and tick the consumer off to give them a smooth process. But depending upon the type of money that you earn, I see some confusion around W-2. Hey, I'm W-2. Why can't you just use my W-2? Well, a W-2 just means you have income taxes withheld from your check. That's it. There are a lot of different streams of income. So you could be a W-2 earner and have a base salary. You can have hourly, you can have bonus, you can have commission, you can have overtime. You have all these variable income streams. And yes, it's W-2 income because the income taxes are withheld from that, but it doesn't mean the lender can use all of it. We can always use like guaranteed flat pay. So a guaranteed base salary, a guaranteed 40 hours a month if you're a W-2 wage earner. Where the distinction is drawn by doing all the documents up front is these variable sources of income that someone receives, we have to dig deeper on those. Bonus, overtime, commission, car allowance, all these things. We can use it, but there are rules around it. Is it a one-time thing? How long have you been receiving it? Is the trend up or down? We have to take an average. And so you can't just take the bottom line number. You have to figure out the bottom line number, how somebody got there. Is it heading down or heading up? Divided by 24 months, 12 months, whatever the rule is. And obviously use that for the projection. So that's part one of the W-2 piece. People need to know it. It's important that they disclose this, and obviously the loan officer, the mortgage advisor ask it up front, because if they don't and there is a hiccup with the variable income, a one-time thing, the decline is down, a lot of times more mortgage companies can't use it at all, or if they can use it, they'll take the lower of the two and they can obviously mess with the income, and you'll find out later the hard way that your pre-approval may not stick. And obviously sometimes it happens if people get under contract, so we don't want that. Now, if you are not W-2, if you are self-employed 1099 person, I could spend hours on this video, but what we're gonna wanna see if you're 1099 or self-employed is your most recent 2 years 1099s along with your most recent 2 years of personal income tax returns, all pages and schedules, because what we're wanting to see is, okay, this person's self-employed, the 1099 is the top line, so this is how much they brought in total. Then there's a bunch of expenses on the tax returns underneath that, and then there's the bottom line, which is the adjusted gross income, and we're gonna look at that number. So if you're 1099 or you're self-employed and you make $500,000 total, but you have $250,000 in expenses on your tax returns, that means your bottom line adjusted gross income is $250, not $500. So we have to see all of that, and we use the $250. Now, again, that is very similar to the trend. Most lenders want 2 years of those tax returns in the same business, same line of work. They want to see an increasing trend. They don't want to see a decreasing trend. They can use it if it's declining. So if 1 year is 200 grand, the next year is 100 grand, they're not going to add those two together, make it 150 and divide. They're going to use the lower of the two. They only use the 24-month average if it's required when it's trending up. So again, 200 grand this year, 200 grand last year, 100 grand this year, they're not going to add them together and divide up because the income's going down. They would only do the 24-month average if it was 100 grand last year, 200 grand this year with an increasing trend. Then they would add them together and obviously divide it and figure out what the income calculation is. So there are a lot of details around this. If you are self-employed and you're an S Corp or a C Corp, not only are they going to want to look at the personal returns, they're going to want to look at the business returns to figure out all the expenses, what's flowing through, what's not. So I say all this to say it should be up to your mortgage advisor to set the stage for you and set realistic expectations. But if you're applying for a home loan, everybody's going to need an application. Everybody's going to need their credit pulled one way or the other to review everything, whether it's a soft pull or a hard pull. And then depending upon your income type and how you're paid, this is where really the meat and potatoes of home loans need to be unpacked for the consumer. A W-2 person just means the taxes are withheld from your check. The total amount of the W-2 is not the end-all be-all number. It's at that W-2 job. How do you get paid specifically? Are there multiple streams? If yes, we got to talk about it. If no, and it's just a base salary or fixed, it's easy, but most people don't have that. On a self-employed 1099 person, right, you're going to need minimum 1 to 2 years tax returns, personal all pages, sometimes 2 to 3 years, and business things here and there, because we all know self-employed people usually do a pretty good job of making money. They just don't always show the best job of, showing the money. And they're going to want to look into that. And again, if it's different lines of work, if the income trend is up or down, all these things matter. So I want to make sure that anybody that tells you otherwise is either not aware of the guidelines, which means they're not smart enough to help you and they should be disqualified immediately, or they don't care. Sometimes mortgage companies and lenders don't care because they're transaction based. Maybe they're a big bank or internet lender. They're not in the business of acquiring clients and keeping the relationship solid. They just want to get through the application, and I call them glorified application takers. Now there are a couple niche home loan products out there that would be separate from this, like a bank statement loan where somebody can't qualify with their tax returns or their W-2s, but they're self-employed and they've got a lot of deposits in their bank statements. Then obviously the lender would want to get the bank statements to look at those. But these are alternative products that maybe 20% of society needs, wants, or goes after because your traditional documents just don't show what they need to qualify. So if you're one of those people, there's a separate video I've done about bank statements and non-QM and alternative stuff. But again, your loan officer should know enough to be able to request all the documents up front. Because the key and the secret to a home loan is if you get all the stuff up front and spend 2 or 3 days doing it right, you will save yourself and everybody else so much headache and time because you don't have to dig through all that stuff on the back end. You want to create clarity. You want to eliminate risk. You want everybody to close smooth and on time, and you want to give everybody a guarantee. So these documents are required. I would recommend not shortchanging the process. More times than not, I see that come back to bite the potential homeowner, their buyer's agent, sometimes the listing agent, and the owner of that house if the deal can't close at all, or sometimes it's delayed. So these are really important things to pay attention to set yourself up for success. And if anybody's giving you any information other than this and saying, we don't need it, don't worry about it, we'll look at later, that's a huge risk. I don't believe that's the right thing to do. I believe gathering these documents, being prepared, getting with a mortgage advisor that knows what they're doing, and spending a little extra time up front going through it all will set everybody up for success, and they will help you get that house, secure that house, close smooth and on time, so it's a transaction that you want to remember forever. So listen, I hope you found this video useful. If you did, do me a favor, like, comment, subscribe, maybe even share it with somebody that you know that could benefit from this information. If you want to talk to myself or our team about your housing needs, your future, or even maybe look at getting pre-approved, do us a favor. Call us, email us, text us. We're always here for you. Until next time, stay tuned.